Why do people always enter at the top and panic at the bottom? And why does it feel like every time you finally decide to invest, the market punishes you immediately? Right now, Bitcoin has crashed hard from its peak. Billions have been wiped out. And people who felt like they were winning just weeks ago are suddenly watching their portfolios collapse. Accounts are getting liquidated, confidence is disappearing, and the same excitement that once drove people in is now turning into fear. But here's the uncomfortable truth. This isn't random, and it's definitely not new. This exact pattern has already played out multiple times, 2017, 2021, and now again. And every single time, most people react in the exact same way. They wait on the sidelines while prices are low, they start paying attention when things go up, they jump in when everyone else is making money, and the moment the market turns, they freeze, panic, and exit at the worst possible time. Not because the market is unfair, but because human behavior is predictable. Markets don't crash randomly, they expose predictable human mistakes. Just a few months ago, people were convinced this was unstoppable, that prices would only go higher, that missing out would be the biggest regret of their life. Today, those same people are questioning everything, doubting their decisions, and looking for the fastest way out. So what actually changed? Did the asset suddenly lose all its value overnight, or did the mindset of the crowd flip under pressure? Because the reality is, markets don't move only on data, they move on emotion. And when emotion shifts, everything else follows. Fear makes people sell. Greed makes people chase, and uncertainty keeps people stuck in the worst possible decisions. And if you really zoom out, you'll notice something even more important. Money doesn't just disappear in crashes, it moves. It quietly shifts from emotional investors to those who understand the game. Which means right now, while most people are focused only on falling prices, something much bigger is happening beneath the surface. A shift in behavior, a shift in confidence, and a shift in who actually controls the outcome. And once you start seeing this clearly, you'll realize why this moment matters so much more than any crash before. Because what happens next won't just decide where the market goes, it will decide whether you end up on the side that builds wealth or the side that keeps repeating the same mistake again and again.
Here's what's actually causing this crash, and why it's bigger than most people think. Most people believe markets fall because of one sudden event, one bad headline, one moment of panic. But that's not how it really works. Crashes don't start when prices fall. They start when behavior changes. And right now, that change has already begun. The first thing you need to understand is this. Smart money doesn't wait for the crash. It leaves before the crowd even notices the risk. When uncertainty starts building, experienced investors quietly move their money out of risky assets and into safer places, not because they're emotional, but because they're protecting what they've already built. And when that shift begins, assets like Bitcoin are usually the first to feel the pressure. Now, at the same time, something else is happening that most people completely ignore. The dollar is getting stronger. And here's why that matters in the simplest way possible. When the dollar becomes stronger, people don't feel the same need to protect their money, so they stop buying assets like Bitcoin. And when fewer people are buying, the price doesn't just stay still, it starts slipping. But this is where things accelerate, because now it's not just people making decisions, it's systems reacting. When investors put money into funds or ETFs, those funds hold the actual asset. So when people start pulling money out, those funds are forced to sell. That selling pushes the price down, which creates fear, which causes more people to sell, which forces even more selling. A drop creates fear. Fear creates selling. Selling creates a bigger drop. And before you realize it, the situation feeds itself. But there's another layer to this that's even more powerful. The story has changed. Just a few months ago, the narrative was full of excitement, bigger predictions, bigger expectations, constant hype. People believed this was unstoppable. But now, that story is fading. And when the story fades, attention disappears. And without attention, prices lose support. Because markets don't run only on logic, they run on belief. And once that belief starts breaking, everything becomes unstable. That's when the most dangerous phase begins. People don't just lose confidence in the price, they lose confidence in the entire idea. And when that happens, decisions are no longer rational. They become emotional, reactive, and fast. And emotional selling is always aggressive, always rushed, and almost always at the worst possible time. So when you step back and look at everything together, you start to see the bigger picture clearly. This isn't just a drop in price, it's a change in behavior, a breakdown in belief, and a reaction chain that most people only notice after they've already been caught in it. And that leads to one critical question. If all of this is happening right in front of you, what are others already acting on that you're still ignoring? Now here's where everything starts to split. Because while some people are panicking and calling this the end, others are quietly saying this could be one of the biggest opportunities in years. So who's right? Is this actually the future of money or just one of the biggest financial illusions ever created? Because if you really listen to both sides, you'll notice something interesting. On one side, you have highly respected investors who completely reject it. Their argument is simple. Real assets are supposed to produce something: cash flow, income, value that you can measure. And if it doesn't produce anything, what are you actually buying? From that perspective, the only way to make money here is if someone else pays more than you did, which leads to a very uncomfortable realization. Are you investing or just hoping? But then you look at the other side and the story flips completely. There are people who see this as a breakthrough, a new kind of asset that could completely change how money works, something that isn't limited by traditional systems. And what makes this even more powerful is this. Some of the strongest critics in the past are now the ones paying attention. They questioned it, dismissed it, even avoided it completely. And yet over time, something made them reconsider. And that's exactly where most people get stuck. Because when experts themselves don't agree, how do you decide what's right? Do you follow logic or chase possibility, avoid the risk or go after the upside? And this is where things start going wrong for most people. Because instead of building clarity, they start reacting to noise. One headline makes them feel confident, the next one makes them doubt everything. They buy when the excitement is high, they sell when the fear takes over. Their strategy changes faster than the market, and without realizing it, they lose control of their own decisions. But here's the deeper truth that most people miss. Uncertainty is not a problem in the market. It's the reason the opportunity exists in the first place. Because if everything was obvious, predictable, and clear, there would be no reward left. The people who actually come out ahead are not the ones who always get it right. They're the ones who stay consistent while everyone else keeps switching sides. So the real question is not whether this is perfect or flawed. The real question is, how do you behave when nobody truly knows what happens next? Because that moment is where everything separates. It's where some people start building wealth quietly and others keep chasing answers that never feel certain.
Now, if you really want to understand what's happening, you need to stop looking at this as a one-time crash and start seeing it for what it actually is, a cycle. Because this pattern you're watching right now, it's not new. It has repeated itself again and again, just with different headlines, different reasons, and different emotions attached to it. Markets move in phases. First, accumulation. This is where almost nobody is paying attention. Prices are low, interest is dead, and only a small group is quietly buying. Then, growth. Prices begin to rise slowly, confidence starts building, and more people begin to notice. Then, acceleration. Prices move faster, excitement increases, and suddenly it feels like everyone is talking about it. And finally, the peak. This is where greed takes over, logic disappears, and people start believing that this time is different. The moment it feels safest is usually the most dangerous, because that's where most people finally jump in. Not at the beginning, but at the point of maximum risk. And right after that, everything flips. Prices start falling, slowly at first, then all at once. Greed turns into fear. Confidence turns into doubt. And the same people who were excited at the top are now rushing to exit. That's exactly where we are right now. And here's the part most people don't want to accept. This isn't unusual. This is how the cycle works. Massive drops have always been part of the process. 50%, 70%, sometimes even more. And every single time, the reaction is the same. People convince themselves that this crash is different, that this is the end, that it's never coming back. And because of that belief, they exit at the worst possible moment. Not because they planned to, but because they couldn't handle the pressure. And that's how the market really works. It doesn't destroy wealth, it transfers it. From impatient people to patient ones, from emotional decisions to disciplined ones. And if you look closely, you'll notice something deeper. The people who lose the most are not the ones who didn't know about the opportunity. They're the ones who didn't understand it. They didn't lack access, they lacked understanding. They chased the upside, but weren't prepared for the downside. They wanted fast results, but weren't ready for long periods of uncertainty. And when reality didn't match their expectations, they broke. That's the brutal truth about building wealth. It's not just about being right, it's about surviving long enough to be right. Because the market will test you again and again. It will test your patience, your emotions, and your ability to stay calm when everything feels uncertain. And most people fail that test, not because they can't succeed, but because they expect it to be easier than it actually is. So the real question is not whether these cycles will continue, because history suggests they will. The real question is, when the cycle turns against you, will you react like everyone else, or will you finally see it differently?
So now the real question is, what do you actually do when everything feels uncertain like this, and every decision feels risky? Because this is where most people start overthinking and end up making the worst possible moves. They look for the perfect answer, the perfect entry, the perfect timing. But the truth is simple. The perfect entry doesn't exist. The perfect timing doesn't exist. And the more you chase it, the more inconsistent your decisions become. The people who actually win in situations like this don't rely on predictions, they rely on positioning. They don't try to guess every move, they prepare for whatever happens next. And that starts with one critical shift. They don't go all in. Because going all in is not confidence, it's exposure. If your position is stressing you out, it's too big. And the moment stress takes over, logic disappears. That's when people panic, exit early, and regret it later. Smart investors avoid that completely. They don't rely on perfect timing, they rely on consistent execution. They show up again and again, whether the market is up or down. They don't chase hype, they don't panic, they don't react. And that's what separates them. Because wealth is not built by getting one big decision right. It's built by avoiding the mistakes that set you back years. It's about staying in the game while others keep getting pushed out. Because the biggest returns don't come from perfect timing, they come from surviving long enough for compounding to do its work quietly. And that requires something most people struggle with: patience. Because none of this feels comfortable. Watching prices fall? Uncomfortable. Doing nothing while others panic? Uncomfortable. Staying consistent when there's no clear answer? Uncomfortable. But that discomfort is the price of long-term results. And if you can't handle that, the market will force you out sooner or later. So instead of asking, is this the right time, ask a better question. Am I positioned in a way that I can handle whatever happens next? Because at the end of the day, it's not about predicting the market, it's about controlling your behavior inside it. It's not about chasing every opportunity, it's about avoiding the decisions that destroy your progress. And once you understand that, everything changes. Because wealth isn't built by timing the market, it's built by controlling yourself. And the biggest risk isn't that the market goes down, it's that you make a decision in fear and never come back.